Alright, so what we have today is a lecture in investing. As I've promised to you guys, I have promised roughly 5 or 6 lectures on technical analysis. So what I have done for today is mostly concepts related to technical analysis. It's the same story for every single class, meaning every single course that we gotta or you have to understand the concepts. So the promise is as follows. Today will be what you guys like to call theory. I know you hate theory, right? And next time we'll try to have the projector. I'll show a lot of the patterns, at least in a theoretical framework. And the last part of the technical analysis, very likely 2 separate lectures, we will look through a couple of dozen, maybe 2, maybe 3 dozen of real-world examples from gold, US dollar, different stocks and everything else as to how these concepts actually apply. Moreover, I have borrowed these examples from the internet, presumably from top technicians, so that you can actually see how real-world modern technicians, meaning in the last couple of months, are actually using them. How they draw their charts, how they make their analysis. Alright, so now we're at the point of technical analysis. I have, let me show you before that a number of books. The one that I like most, probably, let's see if this guy can zoom in. This book is called Technical Analysis of Stock Trends by McGee. It's one of the oldest books that I'm aware of in technical analysis, written in the 40s or 50s. This is the 8th edition. Very expensive book, $99 US in early 2000, in 2001. It's $99, remarkably expensive book. Another book which I liked a lot and recommend is Schwager. Jack Schwager has a book on technical analysis, and this is a short version, tiny little booklet, which is made out of the big one, which is called Getting Started in Technical Analysis. Jack Schwager. He's also got another book called Schwager on Futures. I've also read that one back in the old days. Also really good book. This is another book that I recommend for short-term trading, because you have short-term trends, intermediate, etc. This book I found by Tony Turner to be fairly good, decent book. And finally, this one by Clifford Pistolese, or I don't know how it's pronounced, Italian name, is mostly of exercises. That's also a fairly decent book. So these are some of the books, and of course a wealth of resources on the internet. So now we get to technical analysis. So I've prepared for today roughly 20 or 21 points, concepts, ideas that I'm, let's kind of zoom in at least to see what it is. 21 concepts, points, or ideas that I like to discuss, but my guess is that I'll probably be able to get roughly to 2/3 or 3/4 of it. We'll see how fast I go. So, first is number 1. Technical analysis. So technical analysis is the study of chart patterns and chart behavior, where patterns and behaviors are repeated over time, so that we may possibly expect that they will be repeated in the future. So, chart analysis, technical analysis, is also known as chart analysis. and is also known in short as Chartism. The basic premise of Chartism or chart analysis is that human behavior is fairly stable, fairly unchanging, and chart patterns incorporate human behavior, what chartists call human psychology. So people with their emotions of greed and fear reacted 100 years ago as they reacted 50 years ago, as they reacted 7 or 8 years ago or 10 years ago during the dot-com boom. So the idea is that these are repeated patterns. Alright, the second concept is a natural extension. This is chart pattern. Chart patterns, also known as chart formations. So chart patterns or chart formations. These are graphic representations of price data or of price behavior of what they call unchanging human behavior. Unchanging human behavior. So these are typical patterns or formations which usually incorporate some sort of psychology which throughout the decades repeats over and over and over again. Alright, so now we move to the third concept, which is some basic principles. And the first basic principle is that stocks move in trends. So the first basic principle is that stocks move in trends, or simpler said, that trends do exist. So if there are trends, and if trends exist, and if stocks move in trends, essentially a big chunk and a big part of technical analysis is to analyze these trends. Second, try to recognize them, possibly or hopefully in real time. Third, try to exploit these trends by taking positions, long for a bull trend and a short position for a bear trend. And finally, of course, probably the most important, recognize when the trend is close to its end, or simply when the trend is already over, so that the trader or the investor will exit out of his or her position. The second basic principle is that volume goes with the trend. So, if you're in a bull market and price keeps increasing and increasing, you should be seeing an increasing volume as price goes up. We'll be seeing some later. And if you're in a bull environment when the stock goes up, but it has a temporary movement on the way down, this is called a correction. During the correction, the volume will relatively go down. So on the way up, volume moves with the price, and on the way down, volume moves. In a mirror image occurs in a bear market. I don't want to get into that. There will be plenty of illustrations. So the third one is that trends persist. A trend persists simply means that once the trend is established, the trend goes on and on and on. It doesn't mean it never ends, but it means that it usually lasts for a fairly long time. So once the trend is established, it tends to continue in force. So these are the three fundamental principles related to technical analysis. Number 4 is that there is no universal formula. Investors have tried for 100, possibly more like a couple of 100 years, to find a universal formula or a recipe to make to make money on the stock market by recognizing various patterns and various formations. And the basic premise, which everyone today agrees, this is the one point where technicians don't disagree. They fully agree 100%, is that there is no simple recipe for profits. In other words, in some types of markets, you will be using some techniques and they'll be working a little better. In other types of markets or environments, you'll be using different techniques. Now, point 5 elaborates on point 4. A lot of time you will need fundamentally different techniques and analysis in thin markets. So these are what I've called different approaches are required first in thin markets. So if you're trading on New York Stock Exchange with a lot of experience in technical analysis, and then you get to the Bulgarian Stock Exchange, you will need to fundamentally change your technical analysis, your understanding, your techniques. Formations that were present and repeatable on the NASDAQ or New York Stock Exchange will not likely be present or repeatable here, or here there will be different techniques. So this applies to thin markets, but this also applies specifically to thin stocks. Thin stocks is the same as thinly traded stock. A thinly traded stock is a stock that has very small volumes, very small daily volumes. You get Microsoft, probably a couple of million shares will be bought and sold every day. You get some small mining stock, you may get a couple of thousand, maybe 5, maybe 50,000 shares traded during the day. And you may even get to the point where there is no single trade during the whole day. So, when you have a thinly traded stock, you must be extra careful, and you must be aware that the classical or the standard patterns do not apply. So usually, if you're trading in these, you should develop special skills, you should analyze specifically, and you should follow for a long period of time to develop a feel for the techniques, especially for that market and for that stock, before you get in actively trading back and forth. And finally, special techniques are required in manipulated markets. One common myth that I've heard at least hundreds of times in Bulgaria is that in Bulgaria technical analysis doesn't work simply because the Bulgarian Stock Exchange is heavily manipulated. And there's nothing further from the truth. The opposite occurs. The more manipulated the market, the easier it is to detect with good, proper, sound technical analysis the manipulation. You also must certainly use volumes to detect the manipulation. And once you detect it, once you're aware it, then you work to exploit the manipulation itself. Of course, you have to be able to figure out how the manipulators are working, what their goals are, etc., etc. But the point is that manipulated markets can be traded technically. You could invest in such a market, but you have to be extra careful. One of the largest manipulated markets in the world today is the crude oil market. It is heavily manipulated. It serves political interests, etc. It serves Wall Street interests. So Wall Street is keen on manipulating the crude oil market. Probably, I don't know, like almost a year ago, mid-2007, there was a major collapse in the natural gas market. Well, on the one hand, there was a manipulator that tried to accumulate or almost like corner the market. To corner means to try to get an excessive percentage of the outstanding volume of something. Could be natural gas, could be a stock. And on the other hand, Wall Street investment banks ganged up on that fund and were able to bust the fund, meaning they were able to manipulate the price to the point where the price collapsed and the fund went technically bankrupt. So this is another classic example of manipulation. Alan Greenspan has said, I don't know, 96 or 97, that the Federal Reserve stands at any time to intervene on the gold market when the market requires it. What does it mean, the market to require it? Well, let's explain. This is important in investments. Gold is a barometer of monetary policy. It shows the temperature of monetary policy. It shows or indicates how inflation is possibly increasing. So, rapidly rising gold prices are a really bad signal for monetary policy and the health of the financial and specifically the banking system, and also the currency. So, gold is the barometer, and the central bank, joined with what is called now the gold cartel, are eager to manipulate the gold price. Alright, that's good enough. So, gold is manipulated, silver is manipulated, quite a few commodities are manipulated, other markets may be manipulated. You have to be aware of it. You have to figure out how and the direction and the bias of the manipulation, and then try to exploit it. Alright, so technical analysis uses charts. Charts are of price data and therefore of price behavior. So the point is that of data frequency. Data frequency for very long-term analyses. Very long-term meaning probably a decade or a couple of decades, would be mostly made of monthly data. If you're trying to see, for example, the trend of crude oil over the last 50 or 60 years, you don't really want to use daily or weekly data. You're looking at 50 years. Monthly is perfectly good. If you're looking for, let's say, 5 or 10-year charts, weekly is also perfectly acceptable. No problem with that. And daily is good anywhere from a couple of weeks or months up to a couple of years, 1 or 2 or maybe 3 years. You could work with daily. The point is here that you could use equally well daily as well as weekly as well as monthly, depending on the type of analysis that you're trying to accomplish. I mean, some people are trying to do swing trading. Swing trading refers to short-term and intermediate-term trades. And some people are more like long-term investors, and they try to see the long-term trends. Alright, so the next one is called 7. Patterns. The pattern is associated in part with the trend. So the patterns are divided into 2 groups or 2 categories. The first one is reversal patterns. A reversal pattern simply means that once a specific trend has been established, the trend is broken and the trend changes in the opposite direction. Typically, the shift, let's say from an uptrend to a downtrend, is usually associated or happens with some sort of a reversal pattern. So, reversal pattern is any type of pattern or configuration that usually repeats when trend changes from upside to downside and vice versa, from downside to upside. These are called reversals. This book here by Edwards and McGee, they clearly emphasize that a special attention is paid throughout the book about reversal patterns. In other words, when people see the trend and when common people acknowledge the trend, currently every Bulgarian has seen the trend of rising real estate prices, the key is not to see that it's rising. I mean, every single non-educated person knows that. The key to education and skill is to see when the trend will be over and when real estate prices will begin to decline. In other words, when the trend will reverse. That's the key. That's the hard part, okay? The easy part is to see they're going up. Well, they have been going up for 10 years. I mean, a blind person knows that. So, the alternative is continuation patterns. A continuation pattern is associated with a specific trend, which the trend for a while doesn't perform clearly, and then the trend continues. So a continuation pattern is a pattern where once a trend is established and you see the pattern or observe the pattern, you expect the previous trend not to reverse, but instead to continue in the same direction. Of course, continuation patterns are important. If you've seen, for example, increases in oil prices, as we have for 6 or 7 years now, from roughly 2001, 2000, you want to see if a specific pattern forms, whether oil prices will continue to go up or down. This, of course, applies to any of your investments. Alright, so that's point number 7. Number 8 I have is called Dow Theory. Dow Theory is a theory or analysis of technical analysis that was developed more than 110 years ago by Charles Dow, the same Dow that has on his name you have the Dow Jones Industrial Average. So this is a guy who was also trading markets, who also did a lot of other things, who studied patterns, chart patterns, and who effectively cataloged those patterns. He observed what the patterns are. In essence, he is considered kind of like the father of technical analysis, and currently Dow Theory is not only the oldest, but also pretends, and as far as I have studied different versions and variations, or we call them different technical schools, Dow Theory found to be the most sophisticated and the most helpful, except for a couple of places or points. I'll come to these later. So, Dow Theory is something that if you guys at any point will have any more active investing, or active doesn't mean you trade every day, it means that you have a fairly large amount of money, $500,000 or €1 million or whatever, then you might invest in $99 book. Well, by the time you get to that, it's going to be 200, because right, the dollar is going to have fallen a couple of times. All right, so you see dollars fallen 30% in barely 3 years, right? All right, so the point is, you might as well invest these $100 or $200 and get to really read the book. I found it very helpful in understanding what's going on. Alright, so next is, let me see how I handle it. Well, I'll just move on, is trends. As I explained, trends are fundamental to technical analysis. So you have trends, and trends are associated with cycles. So, which point is that? 9. So, we have mostly, we classify them as 4. The first one is called secular. The second one is called long-term, intermediate, and then you have short term. Sometimes a lot of authors, specifically for day traders, have another one which is known as very short term. So, very short term is associated mostly with hourly fluctuations. Hourly fluctuations. They last a couple hours. For the day trader, they are the basis of his survival. For the regular investor and hedge fund manager, etc., they mean nothing. Then you have the short term. Sometimes they're called daily fluctuations. Dow Theory has a special name, and a lot of people, when you listen to technicians on TV or analysis, they simply call these minor fluctuations. These usually last from, and I'm trying to give you what's called the 3 rule, from 3 days roughly to 3 weeks. This is a ballpark. It is a rule of thumb. It could possibly go less than 3 days. It could possibly go over 3 weeks. But the idea is that, yeah, it's between 3 days and 3 weeks. Then, the intermediate is known as secondary. And the secondary, according to the 3 rule, is 3 weeks to possibly 3 months. 3 weeks to possibly 3 months. The long term is known as the primary, and sometimes it is known and often used as cyclical. It is also part of cyclical analysis. Cyclical. And lasts from 3 months to about 3 years. Usually lasts between 1 and 3 to 4 years. So again, both bounds are flexible, but usually on the longer side. And finally, the secular is known as very long term. And certainly it's way more than 3 years. Usually very long term is more like 10 to 30, possibly 40 years. So we're talking about very, very long-term trends. Let's provide one simple example of a secular trend. Well, gold was in the 60s like $30-some. In 67 or 8, it started a bull market. The bull market, secular bull market, went all the way to $850, so 30-some times increased the price, roughly in 12, 13 years. 13 years, that was the upswing called the secular bull market. On the way down from 1980, gold bottomed in 1999. Other authors might say 2001. The point is that gold market was in a secular bear market for roughly 20 years. So when you take the full cycle, on the way up 13, on the way down 20, you have a full cycle of 30 plus years. Now, within this secular bear market from 1980 to 2000, there were a few cyclical or long-term or primary bull markets. The bull market may last for a year or two and then fizzle and the secular bear returns, okay? Now the general discussion is, again it is not so, let's say many technicians will not agree, but the top technicians do agree, is that you had a secular bull market in stocks in the United States from 1982 all the way to 2000. That was the secular bull market, 18 years. So technicians expect 15 or 18 or possibly 20-year bear market similar to the bear market of the Great Depression, which started in 1929 and continued all the way into the 1940s. Well, the first leg, that's how we call it, the first leg of the secular bear market starts in 2000 and goes down big time to 2002. Now the expectation, or now the analysis says that somewhere from bottoming in 2002 up until 2007, we have a cyclical bull market within the context of a secular bear market. Now many technicians get to agree that what started last year as a downtrend is the next leg of the secular bear market. So what they're expecting is another cyclical bear market, which may last 2, 3, 4, 5 years. Again, it's a whole different story. But the idea is that these are trends. Their boundaries vary a lot. They depend on a lot of other things. The big trick is to learn, study carefully, especially the secular and the long-term trends. They can help immensely the investor, and these are the subject of a separate discipline called cyclical analysis. Alright? So cyclical analysis will be later part of this course, where we try to get some longer term trends in analyzing. Alright, so we have as the next concept trend lines. In a bull market, the definition of a bull market is a rising price or a steadily rising price or an uptrend in the price. So, in a bull market, when you have an uptrend, you connect or you form the trend line by using the bottom points. Let me draw here a line. In technical charts, again, we will see at least 100 in this course within the next 2 or 3 weeks. The one horizontal axis is always time. The vertical axis is price. The price of IBM, of GE, or anything else. And you have price behavior. I'm going to use now, rather than the dashes, candlesticks, I'll show them next time. I'm just going to use the price. It moves. And if this is an uptrend, and the assumption is an uptrend, the trend line in an uptrend is drawn by connecting the lower points so that the chart effectively remains above the bull trend. So this one will be called a bull trend line. In a bull trend line, it acts as a support, which I'll be discussing later, showing later in time. Now suppose that this bull trend has been exhausted, or I ran out of space, so it has turned into a bear trend, whoops, like this, and we want to draw the bear trend. A bear trend is drawn by connecting the top point, leaving the chart underneath. So this will be like this. So this is a fundamental rule in chart analysis with pretty much no exceptions. And this is called a trend line. Besides trend lines, there is the other concept of a trend channel. Very helpful in order to guide you about entering a position once a trend has been established. So, if you believe that a trend is established and you want to assume a position, enter the market, the trend channel becomes helpful. The trend channel essentially is two parallel lines that encompass most of the trading days. So it is based on, in a bull market, from the bottom, the trend line, and extends on the top like this. And similarly here, you use at the bottom. So the trend channel, the main characteristic is that the two lines forming the channel are parallel. That's the key. So the help here is that if you believe that you have a trend channel which forms fairly often, in a bull trend you want to assume the position when you're close to the bottom position. And in a bear trend, you want to assume your short position when you're close to the top. Okay? In either case, the general rule applies as you want to take the position when you're close to the trend line, and you assume that the trend will persist. All right? Is it clear? All right. Let's see what else we have. Then the next concept is of support and resistance. Next time I will have special illustrations for support and resistance. What I may just draw here like a conceptual chart of support and resistance is that this is a small price range where the stock has difficulty going through and penetrating through that price range. So in a up movement, when the trend changes and reverses, this will represent a resistance. So when it comes back up to this point and it reverses again, you have a confirmed resistance. And when it comes down, you have a confirmed support. So resistance means hard to penetrate to the upside. Support means difficulty in moving down on the downside. One of the fundamental rules in technical analysis is that once you have an established support or resistance, in this particular case a resistance. If the resistance is penetrated, the resistance turns into a support. So this here, which so far has been resistance, once it goes above and does its thing, it will get around or back down to that resistance, which now has become a technical support. So sometimes they're called technical support and technical resistance, and they can change roles. There is a possibility that this can go on a few times, and once it gets through back, then this will become once again a resistance. So these are two fundamental concepts. Of course, when you see real-world examples, they're easy to spot, easy to see, and these are probably the most important that technicians in real world observe. They will usually say, well, let's say 850 for gold is a major, or was a couple of months ago, a major resistance, because this was the effective high or the resistance level in 1980, and so far it hasn't been penetrated, meaning by December or whatever, last year, 2007. So technicians were looking for it. Now technicians are expecting or thinking of 850 for gold. That was for many years, more than 2 decades, a resistance. Now it has become an effective support. All right? Is that clear? All right, let's see what's next. Next is a little better understanding of bull and bear markets. Bull markets as well as bear markets run in phases, or what people call stages. So we have a first phase, second phase, third phase. For most technical analysts amongst different schools, they pretty much agree that bull and bear markets run in 3 major phases. The first phase for a bull is called accumulation. Accumulation is the first initial phase of a bull market. It follows or proceeds immediately after a bear market, and usually is done or performed by smart money. The key here is smart money. These are highly sophisticated investors with a lot of knowledge, a lot of experience, a lot of understanding of fundamentals, technicals, and cyclicals. They don't need to understand portfolio for that. Or at least they have very good advisors that advise them to do so. So these are the smart guys which right around the bottom are accumulating because they're confident. These are known or proved later to be what is called in technical analysis strong hands. Strong hands. These are people that in 1991, 2001, 2002, and 2003 recognized that gold is now in a new secular bull market. They know it, they understand it, they're convinced. They're also of decent age, in their 40s, 50s, 60s, or as investor Richard Russell in his 80s. They got plenty of money and they're not afraid to get in the market, and they're strong hands, meaning because gold went up and then it had 20 or 30% correction, meaning the price went down 20 or 30%. They didn't get scared and didn't sell in panic. Instead, they did the opposite. When the market corrected, they bought a lot more. So these are the strong hands. Usually, accumulation phase can run anywhere between 20 and 35% of the total time of the bull market. The second phase, let me see what name I got for it, is called acceleration. Acceleration means that big money, so smart money, now we have big money enters the market. Big money is associated with large amounts of money, and these are the institutions. Insurance funds, pension funds, and other major funds and institutions. Here in this stage, the bull trend is recognized. It is recognized by, so smart money, here is professionals. So these smart money, these are the top guys. These are the cream of the investment world. Very few of them. Smart money will be, in terms of number of people in investment, will be 1 or 2%, at best 3%. This professional money will include anywhere between 5 and 20% of the investment people, but will also include roughly half of the investment money. So we have a fund manager with $1 billion. These today get to wake up to the idea that maybe oil is in a real bull market. The characteristic of the accumulation phase is the doubt by the professionals and by the, what we call here, the mainstream. So, the mainstream doubted in 2002 that oil is going to continue, and then in 2003, and I told you this story during our first lecture. Every year oil went up, they said, no, it's going to go back down. They doubted, they didn't move in big ways into that. So that's the second phase. And finally, the third phase is called, let's see, acceleration. The third phase is typically the mania. These are the small, ordinary people that recognize that the trend is already there. When I wrote an article here in 2004 in Bulgaria, published it, a lot of people thought I was crazy or wasted a lot of time and effort into studying economics and investments. What was clear was that 1997 is or was the hyperinflation in Bulgaria. The real estate market, as well as all financials and everything else, was completely busted. A new cycle began back then. The first accumulation of smart money lasted roughly from about 97 to about 2000 and maybe 2002. So 4 or 5 years, smart money was buying. Then, from 2002, you see major commercial banks trying to outcompete each other for mortgage loans, trying to secure mortgage companies. So from 2002, the mainstream, roughly to about 2005, you had a classical example where major institutions supported the real estate market. They thought, well, they claimed it was in a bull market. They further even got to believe themselves, as well as their investors, that real estate will go on higher and higher forever. So that second stage lasted from about 2002 to about 2004, maybe even 2005. In 2005 to 2008, we have what's called the last stage, or the mania stage, where everybody that has a pulse can go to the bank, get the loan, usually with no money down, and buy a house. Every single guy of little or no experience or competence is or was investing in real estate. So that's the mania. It is also known, during the mania, is also known as a blow-off stage. And what kind of money, guys? dumb money. That's a good bonus point. So, it's a dumb money. That's how it's known. These are the small, unsophisticated people trying to get on board of a trend that has lasted for many years. And they finally seeing that it has lasted for 7 or 8 years. They don't want to miss the train, so they finally jump on it. Dumb money, when they invest, are bound to lose down the road, of course. Well, now we're seeing 2007, especially 2008. Well, real estate market in Bulgaria is fizzling, and we're making the top. And we've already seen real estate market on the Black Sea has already collapsed. Some of the ski resorts has already collapsed. And we are now at the point where in the big cities is close to topping out. So the process or the end of the mania is called topping out. Topping out, so reaching the top. Alright, is this good enough for the bull phases? Alright, let's see what are the bear phases. Well, the bear phases, the first thing to keep in mind is that the logic is exactly the opposite. The first one is that of distribution. Distribution is associated with smart money getting out of their positions and unloading them onto the dumb money. In jargon, they're known as suckers. So they unload them onto the suckers, and the suckers buy and close at the top. So the distribution process is the process of moving from strong hands into weak hands. These suckers will be later called shaken out of the market or shaken out of their positions because they bought on too much margin or because they lost confidence. Again, it always works like that. Next is the panic. Panic is associated with institutional money. Institutions get scared. One major characteristic of institutions and institutional investors is that they behave in herds. How did the two Johns say it? Well, all I was doing was what everybody else in the city was doing. This is absolutely true. The classical example of herding behavior typical of investment professionals, so-called fund managers. So once the downtrend is established and fund managers get to realize it, now the topping process may last a year, may last 2. For real estate, it may last even 3 years, not necessarily. You don't have to think about it as a single moment. Usually many months and spread out over a year, especially when a paradigm like the new economy has been developed and established. So, the panic is by institutional investors and they get to sell and sell. Well, what's going on with dumb money? Well, dumb money are holding. They believe in real estate. They've seen it for 7 or 8 years go up. Then they've seen it in their own hands for 2 years go up. So when it goes for a year down, they keep hoping. Then a second year down, they keep hoping. The bear market is called that it slides the slope of hope. A slope of hope. So the suckers keep on to their stocks or onto their real estate, hoping and hoping and hoping and hoping. Well, ultimately, once they've seen for 6, 7, 8, or 12 years that their positions go down and down and down, they finally give up in disgust, liquidate everything, and swear to God, if they have one, they'll never ever invest in this again, IBM or whatever stock might be, or in gold, or in whatever they invested and saw to go down for 10 or 15 years. In Japan, you've had real estate going down for 16 or 17 years. It peaked in 1990s, it's been going down and down and down. And a smart technician will say, well, they're going to keep going down. Why? Japanese haven't sold in disgust. They haven't been selling and saying, the hell, I'll never ever buy in my life real estate. So the logic goes, there is room to go down. Similarly with .com stocks, well, many of these are bankrupt. Let's say technology stocks like Google and RIM and whatnot. Well, investors haven't really liquidated and sold out in disgust. Finally, there is so-called distressed selling. This is the final phase where everybody that held on to his positions, usually on margin, as price goes down, those that invested, on margin, those that invested on margin get margin calls, they put up some money, they sell out some. Then another wave of selling means more margin calls, more margin selling. So finally, the distress selling is sometimes called the clean out. Clean out, where those that invested on margin get completely liquidated. Another term which is often used on Wall Street is called margined out. Margined out means he got a margin call that he couldn't meet, so his broker sold him out or liquidated his positions completely. Well, why would they liquidate the position completely and not partially? Well, because brokers make more money by liquidating the full position. If you want to get back in again, you gotta buy again. For the broker means yet another commission. So it generates for them more commissions. Alright, so these are the phases. Now, volume. Many, especially modern schools, or let's call it modern currents in technical analysis, emphasize only price patterns and usually ignore volume. Here, Dow theorists emphasize that volume is extremely important. Volume tells tales. It gives you a lot of clues when especially you're in doubt. So they say volume is extremely important, and there is a saying or adage on Wall Street that in order for stocks to go up, there must be some buying. But in order for stocks to go down, they can simply fall out of their own weight. Let me see how I have it, if I have it here. It says, the saying goes, it takes buying to drive the stocks, up, but they can fall of their own weight. In other words, if you're in a bull market, in a bull trend, you gotta watch the volume. You may only have a correction, so volume is extremely important. Alright, let's see. Another very important indicator, 15. How much time we got, guys? 5. Only 5, okay. So, another important part of technical analysis is sentiment. Sentiment means how investors feel about the invested asset. Today in Bulgaria, there is this sentiment which suggests that real estate prices can never, ever possibly fall down. And sure, they collapsed in the US, but the US is a different continent. They collapsed in UK, in Spain. Now they're about to collapse in Greece. Well, they already collapsed on the Black Sea, but in Sofia, that will never, ever possibly happen. When people have that kind of sentiment and that kind of beliefs, you are right around the top. You're right around or close to the top. So you have what's called bullish sentiment and bearish sentiment. Today you have a classical example of a bearish sentiment in crude oil. Crude oil has been going up for 7 years in a row. Every single year it's been up from the previous year. And still the bearish sentiment prevails on Wall Street. Still, if you ask Wall Street, they will tell you that oil in 2008 will go down. Most of the major investment banks and top economists and everybody else tell us that oil is going to be in the 70, 80 range. Possibly they admit that the average might be 85. They are still bearish because oil is over 90, it has been over 90, and early this year it was over $100. So they still have this bearish sentiment, which they have not abandoned for the last 7 years, which they have held for 20 years. Oil like gold has been going down for a good 20 years. So they've had the bearish sentiment for 20 years, and 7 years later they still cannot shake off their bearish sentiment. Well, what this got to do with the market going up? Well, the answer is very simple. When everybody is bullish and they're convicted that it's going to go up, they have already bought into gold or oil or real estate. There is no more money to enter the market. You need a classical or typical bearish sentiment so that there is continuous flow of money. If we're here 100% bullish on gold, we all have already bought gold. Who's next going to buy gold? That's the way to think about it. That's the correct logic. The correct logic is that there's got to be another buyer. And if everybody is bullish, that by definition means they already bought. Where's the next buyer going to come from? Well, the answer is when everybody's bullish, there are no more buyers around. All we're left with is sellers. So when you have a market with lots of sellers and few buyers, the result is prices go down. Similarly, do you have or see bearish people in the real estate market today? Well, I see myself, a lonely guy, probably a few of my friends, maybe another 100 people in Bulgaria. Up against these 100 people are 3 million Bulgarians that firmly believe that real estate prices will continue to go up. So, you have extreme bullishness in real estate. That's a sure indicator we're in the process of topping. We are, with respect to oil, still in the, I've deleted it, in the doubt phase. If professionals are still in the doubt phase, oil still has a lot more to run from here. And we're still many, many years away from the classic mania that may drive oil to 1,000 easily. Right, that sounds shocking, right? It's only 100 now. So going up 10 times is no big deal. I mean, oil went up from $1.25 to $45 from 70 to 80. So in 10 years it went up 30 times. So now we shouldn't expect it to go any less, especially that we have peak oil and all this stuff. We would expect oil to be even scarcer than it was in the 70s. So if back then it went 30 times, now it could go even a lot more. And then if you add a weaker dollar, where now the dollar is clearly a lot weaker than it was weaker in the 70s, you get an extra kick in terms of the weaker dollar. If you measure oil and gold, it hasn't changed much over the last 20 or 50 years or 70 years. So part of it is a little trickier, but I'm not going to get into at least this course about it. So it's time, is it? Alright, well, thank you very much, guys. I'll continue with some of these concepts next time, and then we get to charts and real stuff.